Hello, everyone, and welcome to our July Reg Brief. This is your monthly checkpoint for the important developments that happened in June. I am Robert Brosh, Director of Regulatory Intelligence here at Ncontracts, and today I am joined by two people who are on top of all of the change that is happening in the industry. We have Jenna Zakarowitz, our Regulatory Intelligence Counsel, and then a new face, Rebecca Tetro. She is our Senior Regulatory Intelligence Counsel. Becky, we are very happy to have you joining our team and joining the Reg Brief. Becky brings a lot of experience across a variety of different financial institutions. So welcome, Becky. June was a packed month. We will go ahead and, as always, start with our biggest, hottest industry-wide developments that impact everyone, and then we will go ahead and zero in on our depository institutions. So we will go ahead and kick it off with the CFPB and Congress, who I think is not too happy with some activity by the CFPB. Becky, you want to give us the update there?
Yeah, thank you, Robert, for that warm welcome. And hey, everyone. So as Robert mentioned, I'm going to kick us off by starting out our section on the CFPB. They've been very busy this month. If you've been relying on their website as a research and compliance resource, this is your heads up. A significant amount of the content on their website is now gone, and the situation is getting more complicated by the week. Starting in May of this year, the CFPB removed thousands of pages from its public website. I'm talking about 15 years of content, including blog posts, press releases, speeches, testimony, consumer advisories, settlement notices, and ding, 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 all 35 supervisory highlight reports going back to 2012. Now, that last one is especially notable for our industry. Those reports were one of the most practical tools available for understanding what examiners were finding on the ground. Real supervisory observations, anonymized, but still specific. They've been a go-to resource for compliance teams and examiners alike. They're now gone from the official site. Still available, though, are the interactive regs and final rules, the exam manual, consumer complaint program, including the Submit a Complaint portal, the complaint database, and access for logging in to respond to complaints, and a much lighter guidance section. So on June 22nd, 4 Senate Democrats, led by Senator Elizabeth Warren, sent a formal letter to Acting Director Vaught demanding answers. They asked who authorized the deletions, where the records are now being preserved, whether any of the content will be restored, and whether the agency plans to continue publishing consumer advisories and the supervisory highlights going forward. The response deadline is July 2nd, so only a couple days. Whether and how the CFPB responds will tell us a lot about the agency's direction on transparency and public guidance. Here's a few practical takeaways for you. 1, don't count on the CFPB's website as a stable reference. If your compliance program, policies, or any training materials link to CFPB resources directly, check those links now. A lot of them are going to return 404 errors. 2, the supervisory highlights aren't fully gone just yet. Much of the removed content is still accessible through the Internet Archive's Wayback Machine, but it does lack search functionality and availability can be spotty. So if you find it, save it down now. And number 3, watch what replaces these resources. The CFPB hasn't published new consumer advisories since the acting director took over. If supervisory highlights aren't going to continue in their current form, compliance teams will need to identify other sources for supervisory trend intelligence. Peer benchmarking, trade association guidance, and exam findings sharing through industry groups will become more important. Stay tuned for that July 2nd response deadline and make sure your team isn't caught flat-footed when a link they've been relying on no longer works. We'll keep on tracking this one.
Thank you, Becky, and great first updates. With that, Becky did mention that the CFPB still does have the consumer complaint database up on its website. However, it has stated that it is going to correct what it calls flaws and restore integrity and utility to the consumer complaint system. So as we know, CFPB doesn't necessarily have a ton of resources and personnel on hand to maintain the consumer complaint database as it exists today. Just for a little history, in 2019, the Bureau had received more than 150,000 complaints. In 2025, that number was more than 5 million, which I think the CFPB, I didn't check their math, but it says it's about a 3,700% increase. So of particular concern for the CFPB here is the number of complaints that are coming in related to credit reporting. Year after year, we talk about it all the time. That is the number one subject for complaints. And according to the CFPB, use of that portal by credit repair organizations, so those companies that are going to consumers and telling them that they are able to bring their credit score up from a 650 to 750. They are using the complaint database and the system in order to do that. The CFPB also says that social media influencers are advocating for use of the portal. And also they cite that AI tools are helping consumers submit complaints faster, more efficiently, and that has led to an abuse of the portal. And so on top of that, the CFPB also states that with the system, consumer reporting agencies, so your CRAs, they haven't been uniform and been using it effectively in how they respond to complaints, which has ultimately led to inefficiencies and long resolution times. So in response, the CFPB has issued a revised company portal manual, and that is going to provide information on how companies should use response closure categories. It has also implemented a two-factor authentication for online accounts of submitters of complaints. That includes verification as well of both email addresses and mobile phone numbers. It is now requiring third parties to identify and explain their involvement in the complaint process if they are acting as an intermediary. And then the CFPB is looking to implement APIs in order to more efficiently share complaint information with consumers and with companies. And so really these changes are coming on the heels of a CFPB credit and reporting complaint notice that they issued earlier this year, basically stating that consumers are first required by law to dispute information with a credit reporting agency before going to the CFPB. I think reasonable minds could differ here. I think if you read the actual law, I think that is a subjective reading, isn't actually a statutorily mandated requirement, and that consumers likely can go to the CFPB directly. But whether or not the CFPB actually does anything with those complaints that come in before a consumer goes to a CRA, that's kind of a wait and see situation right now. So all of that is to say a complaint resolution process within your institution is still extremely important, right? Your intake channels, your flagging, your response times, your tracking, resolution documentation, and communications to both regulators and consumers. That is vital to ensuring that you have resolved complaints in a timely and accurate method. And just because there might be less complaints coming from the CFPB to your institution doesn't mean that there are less complaints coming from the CFPB to your primary banking regulator, who is then going to pass it along to your institution. So that makes customer service all the more important right now. Final reminder is just that for your credit reporting disputes, we talk about credit reporting a lot. If your institution does receive one directly from a consumer, you do have a duty under the FCRA and Reg V to investigate and correct any inaccurate or incomplete information with a consumer reporting agency. So don't let that part slip through with all of this talk about complaints received by, the CFPB or agencies or a consumer reporting agency directly. All right, so that is a lot, and we are still sticking on the CFPB train. I think we have an enforcement activity, not necessarily an enforcement action. Jenna, was that with a fintech? Is that correct?
Yeah, so the CFPB had announced this month they were working with a fintech to reimburse customers who had been impacted by a wide range of errors when the company transitioned to a new bank partner, including rent and mortgage payments not being sent and subpar customer service, which was provided through AI chatbots. Now, like you said, no formal enforcement action was filed, but the CFPB said that they had worked with the company and that this company had taken steps to guarantee that all transition-related technical issues were solved. They submitted documentation to the Bureau showing that they had completed the process and they were back on track. Now, the CFPB explained that this collaborative process illustrates the administration's new enforcement principles, which focus on addressing real demonstrable harm to customers while grounding enforcement in clear statutory authority with respect to due process. Now, the agency is going to prioritize collaboration with institutions and encourages self-reporting and voluntary remediation to resolve issues quickly and efficiently. And the CFPB also stated they are going to avoid duplicative enforcement efforts that are already being handled by state or other regulators, which differs from previous administrations, which historically worked with other litigating parties in a pretty collaborative manner. The agency is going to continue to monitor the fintech's progress until every impacted borrower is fully reimbursed, and they stated that they will provide another public notice when that happens. And if you want to hear more about this enforcement action and other enforcement actions that took place in the month of June, you can read this month's enforcement action roundup.
Definitely check out that enforcement action roundup. Keeps you up to date on exactly what is happening across the industry and across the regulators and what they are paying attention to. All right, we'll switch to lending focus now. Still with the CFPB, we have a new statement on ability to repay. Becky has the info on that one.
Thanks, Robert. I've actually got our next two items from the CFPB, and they're both related to reshaping the fair lending landscape, specifically around who gets credit and on what basis. And they both reflect the same philosophical shift away from race and protected class conscious credit policy. So first up, we've got that new guidance that was issued on June 8th, which has some real implications for your lending operations, specifically around how immigration status factors into your ability to repay analysis. It's not a final rule, but it is a formal agency statement. It's published in the Federal Register. And so the compliance expectations it outlines are ones you really should understand. The statement reminds creditors that under TILA and Reg Z, you're required to make a reasonable and good faith determination of a borrower's ability to repay. And that means accounting for all information available at the time you make the credit decision. The key point here is if information in the application or supporting docs that you have indicates that a borrower's income could be disrupted due to their immigration status, specifically looking for a risk of removal from the US, the CFPB says you may be obligated to factor that in. Ignoring that information could mean your ATR determination is not reasonable. The Bureau also flagged ITIN use as a potential indicator of that unlawful precedence, since ITINs are issued to taxpayers who lack proof of legal residency. That's a notable signal for mortgage lenders and card issuers to pay attention to. On the fair lending side, the CFPB cited Reg B, which has long permitted creditors to consider immigration status as part of underwriting, but the line between permissible consideration and discriminatory treatment based on national origin still remains a real compliance risk that this guidance doesn't fully resolve. This one requires some careful policy work, and here's a few things to think through. First, review your ATR policies and underwriting guidelines to ensure they address how immigration status-related income risk is evaluated, especially for those mortgage products and credit card accounts. Second, don't treat ITIN use as an automatic disqualifier. The guidance identifies ITIN as a relevant data point, but it's not a bright line denial trigger. Blanket denials based on ITIN could create fair lending exposure under ECOA. Third, document your reasoning. Whatever approach you take, your file should reflect that you considered all available information and made a reasoned and reasonable determination. That's the compliance record you've got if an examiner asks. And finally, keep watching this space. The guidance is explicit that it doesn't cover every immigration status scenario, so additional clarification might follow. The bottom line here is that immigration status is now a legitimate and sometimes required factor in your credit analysis, but implementation is nuanced and getting it wrong in either direction carries some risk. Keep an eye on this space for further clarifications or updates. Next up, we're going to move on to rescission of ECOA special purpose credit programs. And if your institution offers or has been considering offering a special purpose credit program, there's been a significant regulatory shift you should know about. On June 17th, the Bureau formally rescinded a 2020 advisory opinion that many lenders have been using as a roadmap for designing the programs. Here's what changed and why that matters. The 2020 advisory opinion clarified how for-profit organizations could structure the programs. It said, among other things, that SPCP participants could be required to share common characteristics like race, national origin, or sex. That opinion has been widely cited by lenders building out SPCP frameworks. However, the CFPB rescinded that advisory opinion effective June 17th, and the reasons are twofold. In April of 2026, the CFPB finalized Reg B amendments that directly contradict the 2020 opinion, stating that for-profit SPCPs can no longer use race, color, national origin, or sex as eligibility criteria, and the bar for demonstrating need is higher. Programs must serve people who actually would be denied credit, not just those who would probably be denied credit. Secondly, the Bureau also cited some constitutional concerns stemming from the Supreme Court's 2023 Students for Fair Admissions decision as additional grounds for the rescission. This action is part of a broader fair lending realignment happening at the CFPB right now, as I just discussed. Taken together, these two actions reflect a consistent direction from the current Bureau. Underwriting should be grounded in income, repayment capacity, and financial risk, not in protected class characteristics, whether used to expand or restrict access to credit. Your fair lending program should account for both sides of that shift. If you have an SPCP in place, or if you've got one in development, this is a mandatory policy review moment. Programs designed using the 2020 opinion as a guide, especially any that use those protected class characteristics as eligibility factors, should be evaluated against the April 2026 amendments, which are now the sole governing standard. Back to you, Robert, for our next item.
Thank you, Becky. All right, so now we have from all of the federal banking regulators, as well as the Treasury, the FHFA, the CFTC, the SEC, I think that's all of them. I might have forgotten one. But they have all established and issued a joint final rule to establish data standards that improve the way financial regulatory data is shared and used across the agencies. And so this rule does take effect on October 1st, 2026. For financial institutions, though, I think it's very important to note here that effective date in this rule does not require reporting changes immediately. It is basically going to require the agencies to begin passing their own rulemaking, incorporating the standards that they have agreed upon. But what to kind of know and prepare for from these standards is the fact that it has established the legal entity identifier as the numeric identifier for entities. So for your financial institutions, right, I'd be prepared to likely provide this LEI on all information that you are submitting to an agency. The data that you are submitting, especially for dates, now must follow the ISO standard for dates, which follows the year, month, and day international standard. I know for me that I would get that very confused. I'd get day and month switched around all the time. And then additionally, these standards also include product identifiers, financial instrument classification, currencies, and U.S. Postal Service codes. So really the goal of this, again, is to increase the communication and the working together by all of the agencies, as well as the fact that the regulators have to make the data fully searchable, machine readable. That way it is much easier to surface and find information. So for financial institutions, begin considering how you will likely need to comply with the joint standards as they are implemented through those agency rulemakings, and start looking and thinking about potential compliance issues, keeping in mind right now that we are still in the early stages and that each agency has some flexibility in how it implements those standards. All right, so that was a lot on the federal side. Another thing that we have been mentioning a lot about is the fact that states are going to step up in enforcement areas where the federal agencies are taking a step back. I think we have New Jersey who is doing just that. Jenna, what is New Jersey up to?
Yeah, their Attorney General and Division of Consumer Affairs issued an enforcement statement regarding junk fees, warning businesses that the Consumer Fraud Act covers junk fee practices. Now, the Consumer Fraud Act prohibits deceptive, unconscionable, and abusive conduct and covers a variety of practices that companies use to charge consumers junk fees in connection with goods and services. So, for example, deceptive conduct includes affirmative misrepresentations about material information that has the capacity to mislead. Under that interpretation, hiding mandatory fees or misrepresenting the purpose of those fees would be considered deceptive under the CFA. The statement also highlights unconscionable and abusive junk fees. The New Jersey Supreme Court has described unconscionability as conduct that indicates a lack of good faith and honesty and fair dealing. And the letter highlights how distorting prices and fees can fall under that category. Sellers that are unbundling the price of products into numerous fees can hide the true price of products and prevent customers from being able to truly comparison shop and force customers into paying more than anticipated. Now, while this New Jersey specific item may not be applicable to you, it is showing that growing trend of states picking up where the CFPB and federal government have left off. Financial institutions really need to remain vigilant when it comes to junk fees. They still remain a compliance risk. Regulators are looking at how fees are being disclosed, whether you're obtaining informed consent from your customers, and whether add-on products are delivering real value to customers. So now is a good time to review your fee structure, review your disclosure language, because the scrutiny is not going away.
Good update, Jenna. Yeah, it looks like New Jersey is reviving the junk fees terminology that really popped up around the Biden administration time. All right, we will go ahead and switch now to depositories. So for our banks and for our credit unions, this time we are going to talk about interchange fees. Feels like we've been doing that for the last few months, and this month isn't any different. However, this time we are talking about Colorado and not Illinois. So we did have the Colorado governor veto that state's legislation that was going to prohibit interchange fees on the sales tax portions of card transactions, only for financial institutions that exceeded 60 billion in assets. But the governor with this veto did cite federal preemption risk and operational infeasibility, right? There's been a lot of conversation about how do you actually determine what part of a transaction is the sales tax or the gratuity portion versus the actual price of the good or the service. And so just as a reminder, right, this is coming on the heels of the Illinois Interchange Fee Prohibition Act, which we have seen a lot of activity around. We did recently have the Illinois General Assembly extend the IFPA implementation date to 2027. And then we also had a court recently rule that the IFPA does not apply to out-of-state banks and national banks, but it did state that it did apply to credit unions, both federal and out-of-state and in-state chartered. With more than a dozen other states out there with similar proposed laws, I do think it is a safe bet that many will wait to see the resolution of the IFPA, just like Colorado. So I just mentioned that that court ruling for Illinois didn't include credit unions in the preemption. So in response, or maybe getting ready for that ruling, the NCUA did implement an interim final rule, which was effective the day of recording, June 30th, 2026, and that clarifies that federal credit unions have explicit authority under the Federal Credit Union Act to impose non-interest charges and fees, and that includes interchange fees for credit and debit card transactions. NCUA is basically coming out, right? They're trying to say it has exclusive authority over those charges and that any state law that conflicts with that authority is preempted. And so NCUA did pass that regulation. NCUA is attempting to follow in the OCC's footsteps and have the IFPA and other state interchange prohibition laws not apply to federal credit unions. One important note there, just to maybe keep track of, keep in the back of your mind, is that unlike national banks, the Federal Credit Union Act only preempts state laws relative to loans and lines of credit by credit unions. So while credit cards may be able to be grouped into that category, debit cards, which also have interchange fees, that is less likely. So we will need a decision by the court. It has been appealed, and they are going to take a look at the IFPA in relation to this NCUA interim final rule, but it will probably require a bit more of a legal analysis and interpretation than the court's prior decision for national banks. Definitely something we are still watching closely, that we will provide updates on in Ncomply as they do come through. But good news is I think that a lot of states are probably going to put their foot on the brake when it comes to interchange fee legislation for now. Sticking with NCUA, we do have finally some action, I think, coming from all of the deregulation activity that they had in 2025 and 2026. We do have a new final rule. And Becky, I think you have the information on that one.
Yes, I do. Thanks, Robert. The NCUA has finalized some updates to its vital records preservation rule, Part 49. And if your team has been relying heavily on the appendices to that rule for years, you'll either be really glad or really sad to hear what's changed. The final rule does 3 things worth knowing about. First, and most practically, it eliminates both appendices. Appendix A, the Record Retention Guidelines, and Appendix B, the Catastrophic Act Preparedness Guidelines. The NCUA heard you all. Appendix A stopped functioning as guidance and really started functioning as a de facto requirement, leading credit unions to retain records beyond what they actually needed to for disaster recovery, which is what the NCUA is trying to solve here. For Appendix B, NCUA does plan to make that content available on its website for reference, but it's no longer incorporated into the regulation. Next, the new rule tightens the definition of vital records. Going forward, vital records are specifically the records your credit union needs to restore core member services after a catastrophic event. That means member account balances, month-end financial reports, bank reconcilements, investment and account listings with contact information, and emergency contact information for staff, officials, and vendors. That's it. Lastly, the records preservation log requirement has been relaxed. The previous rule was very prescriptive about what the log had to include, but the final rule leaves format and content up to you, and that includes fully electronic logs, as long as the log helps you locate and access vital records when you need them. NCUA is not expecting credit unions to manually create or maintain this tool. One important point to remember on this one, though, Part 749 is not a general records retention framework, nor does it affect your record-keeping obligations under other regulations. The narrow vital records definition doesn't mean other records can be purged. Make sure to review your broader retention schedule separately from this. For your compliance calendar, if your Part 749 program has been built around Appendix A's recommendations as if they were mandates, it's about time to revisit that program and right-size it to what is actually required. July 16th is your effective date, so use the time between now and then to do that review.
Thank you, Becky. All right. And then we had some late breaking end of the month proposed rules from the FDIC. We had a few of those. I just want to touch on 2 real quickly. The first rule is revisiting deposit insurance assessments for FDIC insured banks, that is looking to raise the asset threshold that separates a small institution from a large institution, and they're looking to change that threshold from 10 billion to 30 billion. And that would happen immediately upon the effective date of the final rule, whenever that may be. And it would reclassify a large chunk of banks into the lower cost small institution pricing framework, right? So assessments on what you pay for deposit insurance and to make sure that your borrowers or your consumers, your depositors, are insured is based on your institution's asset size. The larger the asset size, generally the higher price the institutions have to pay. With that proposal, the agency is also proposing some rate reductions across the board. They are proposing a new voluntary resolution readiness adjustment that is going to give large, complex institutions up to a 1 basis point break on their assessment rate. So a lot happening around FDIC insurance operations. Then we also have another rule that is modernizing information disclosures for FDIC insured banks. They are now, as proposed, going to be potentially able to share confidential supervisory information with affiliates, outside counsel, auditors, service providers, including fintechs and vendors there, and potential merger partners without the necessary FDIC approvals that are generally needed currently, providing that you do have a confidentiality agreement in place. All right, I think I got through those. Again, I love the end of the month proposals that are coming from the regulators. You know, we keep hearing deregulation, but there is still certainly a lot coming down the pike. So on behalf of Jenna, Becky, and myself, thank you all for listening. Again, a lot of change happening on the federal and state landscapes, and determining applicability based on certain characteristics, nuance like charter type, like the states that you do business in, and federal preemption do make understanding compliance obligations and prohibitions difficult. That is why Ncomply gives you all of this information and more tailored to your institution, including a lot of regulatory updates, guidance, and news that we haven't talked about today. So make sure that you tune in next month for the hottest updates from July in the next month's Reg Brief. Thank you all.